If you have a revocable living trust, a will, or even just a simple beneficiary form on a retirement account, I need you to listen very closely to what I'm about to say. There is a massive expiration date coming in 2026 that most seniors have absolutely no idea about. And if you ignore it, you could accidentally leave your spouse with a six-figure tax bomb. Or worse, leave your children fighting in probate court for 2 years. I'm not being dramatic. This is about a ticking clock embedded in the tax code that is going to reset the rules of the game entirely. You see, back in 2017, Congress passed a law that effectively doubled the estate and gift tax exemption. It was generous, it was historic, but it was never permanent. On the 1st of January 2026, that law sunsets. It evaporates. And when it does, the amount of money you can pass to your heirs tax-free is going to be cut roughly in half. If you are sitting there thinking, well, I'm not a millionaire, so this doesn't apply to me, I need you to stay with me. Because the way this expiration interacts with your beneficiary designations and your trust documents could trip up even a modest retirement nest egg. I'm going to walk you through exactly what you need to update before the clock runs out. Why doing nothing is the riskiest move you can make, and the specific accounts you need to look at right now to protect your family. Let's start by addressing the elephant in the room, because I know what you might be thinking. You hear the words estate tax and you immediately picture a mansion in Beverly Hills or a sprawling ranch in Texas. You think this is a problem for billionaires. I get it. But the reality is that because of inflation and the rising value of real estate over the last 20 years, a lot of regular middle-class seniors have quietly become estate tax millionaires on paper, without even realizing it. Think about it. You bought your home in 1990 for $90,000. Today, if you live in a decent suburb, that house might be worth $400,000, $500,000, even $600,000. Now add your 401k, your IRA, that life insurance policy you bought 30 years ago that has a death benefit you forgot about, and maybe a small rental property you kept as a retirement income stream. Before you know it, your net worth is knocking on the door of $1 million or $2 million purely because assets appreciated over decades of disciplined living. Right now, in 2026, the federal estate tax exemption is sky high. It sits somewhere north of $13 million per individual because of inflation adjustments. You can leave up to that amount to your kids without paying a single penny in federal estate taxes. But here is the part that should make your stomach tighten. If Congress does not act, and honestly, with how divided things are in Washington, we cannot bank on that. That exemption is scheduled to fall off a cliff. We are talking about it dropping down to somewhere around $6 or $7 million per person, adjusted for inflation. Now, if you are married, you might think, well, between my spouse and me, we have double that, so we are fine. And you might be, but only if your documents are structured correctly. If your trust or will is old, it might force everything into your spouse's name without utilizing what is called portability, effectively wasting your exemption and setting your children up for a tax hit on the back end. This is why updating your beneficiaries is not just some clerical box to check. It is the central nervous system of your entire estate plan. I want you to visualize your retirement accounts for a moment. These are usually your IRAs, your 401ks, your 403bs, maybe an old thrift savings plan. Most people fill out the beneficiary form the day Human Resources hands it to them on their first day of work, and they never look at it again. That piece of paper supersedes your will. I will say that again because it is the most common and devastating mistake I see. The beneficiary designation form on a retirement account overrides whatever you wrote in your will. You could have a beautiful, leather-bound, lawyer-drafted will that says, "I leave everything equally to my 3 children," but if the beneficiary form on your largest IRA still names your ex-spouse from 15 years ago, that money walks out the door to the ex-spouse, no questions asked. Now, looking ahead to 2026, the risk is deeper than just having the wrong person named. The risk involves how that inheritance will be taxed and distributed. With the Secure Act changes we have seen in recent years, most non-spouse beneficiaries, meaning your adult children, can no longer stretch out the distributions from an inherited IRA over their entire lifetime. They have to drain that account and pay the income tax on it within 10 years. When that expiration date hits in 2026, and if the tax brackets potentially revert to the higher pre-2017 levels, your kids might be inheriting your IRA right at a time when income tax rates are higher. If you leave them a $400,000 IRA and they have to pull it out in 10 years during their peak earning years, you are pushing them into a much higher tax bracket. Without updating your planning now, you are essentially signing your kids up for a 40% tax haircut on the hard-earned money you saved. So, let's talk about the specific document that holds the most danger if left untouched. The AB trust structure, also known as the marital bypass trust. If you did your estate planning back in the 90s or early 2000s, there is a very high probability your lawyer set up an AB trust for you. Back then, the estate tax exemption was only $600,000 or $1 million. To save a married couple from paying taxes when the first spouse died, lawyers would split the trust into 2 parts when the first spouse passed away. Part A was the survivor's trust, revocable and tax-free to them. Part B was the bypass trust, which was irrevocable, designed to hold the deceased spouse's exemption amount so the kids would eventually inherit it free of estate tax. That formula was genius for 1,999, but it is a nuclear disaster waiting to happen in 2026. If your trust document has a mandatory formula that reads, "Fund the bypass trust up to the maximum estate tax exemption," and the exemption is currently $13 million, you could accidentally force your entire net worth into an irrevocable trust upon the first death. Can you imagine the shock? Your spouse passes away, you are grieving, and suddenly your family attorney tells you that you cannot touch the principal of half your investments without a trustee's permission because the old document locked it up. By updating your beneficiaries and trust structure now, you can convert that old AB formula into what we call a disclaimer trust, or simply rely on full portability, giving the surviving spouse complete control and full access to all assets without court involvement, while still protecting the exemption in case it drops in 2026. Let's shift to the very specific piece of your life that often gets ignored until it is too late. Life insurance policy beneficiaries. Many seniors hold permanent life insurance policies, whole life or universal life, with substantial death benefits. You bought it for peace of mind, but peace of mind requires maintenance. The death benefit itself is usually income tax-free, which is fantastic. But here is the technical trap. The death benefit is included in your taxable estate for federal estate tax calculations. If you are the owner of the policy, it counts. So, if you are a widow or widower, and your total net worth plus the face value of your life insurance policy exceeds that lower 2026 exemption threshold, you have just mousetrapped your kids into an estate tax liability on a product that was supposed to be simple protection. A simple update, such as transferring ownership of the policy to an irrevocable life insurance trust or ILIT, removes the death benefit from your estate. But you have to do it at least 3 years before you pass away. The clock is ticking. If you wait until you get sick in 2027, that 3-year look-back rule traps the money in your estate. So, if you are healthy today and sitting on a large permanent policy, this expiration date is your signal to make that move right now. Do not let the tax man become your primary beneficiary. Now, I also want to have a gentle but direct conversation about a topic that nobody wants to think about, but it is critical for surviving spouses: bank account beneficiaries and payable-on-death designations. So many seniors in this age group grew up in a generation where you just put your kid's name on the bank account as a joint owner because it seemed like the simplest thing in the world. Mom adds daughter to the checking account so daughter can write checks for the nursing home. It sounds logical, but that act is effectively making an unrestricted gift. If daughter is a joint owner, that money legally belongs to her the moment you pass away, regardless of what your will says about splitting things between multiple siblings. Even worse, if your daughter has financial trouble, maybe a lawsuit, a bankruptcy, or a divorce, that entire joint account is considered her asset and can be seized by creditors. The safer, more elegant solution, especially with the 2026 exemption uncertainty looming, is to keep the accounts in your name but execute a simple payable-on-death designation, a POD. This keeps you in complete control until your last day, and only then does the money transfer directly to the named beneficiary, bypassing probate entirely. Walk into your local branch or log on to your banking portal this week and verify that every single account, from your high-yield savings to your certificate of deposit, has a current POD designation that aligns with your estate plan. Another layer of this that I really need you to understand involves the state you live in. We have been talking about the federal expiration date, but some states have their own separate estate or inheritance taxes with shockingly low thresholds. If you live in Massachusetts or Oregon, for example, the state estate tax exemption is fixed at $1 million or sometimes even less. That number has not moved in tandem with the federal number. So even if the federal exemption is $6 million in 2026, your state might still be taxing every dollar above the first million. When the federal rules change, it can often trigger a review of state laws, or it can simply leave you exposed. This is why your beneficiary updates need to consider state-specific planning. If you retired to a different state than where you originally drafted your will, you are living under a completely different set of rules now. The documents that worked in New York might fail to protect you in Florida, and vice versa. A snowbird lifestyle does not excuse you from having a clear domicile plan. Updating your beneficiaries and having a sit-down with a local elder law attorney in the state where you actually spend the majority of your time is not an expense. It is a vaccine against a future chaotic probate. I want to walk you through a very specific real-world scenario that highlights the intersection of the 2026 tax expiration and beneficiary blunders. Imagine a couple. We will call them Robert and Susan. They have a net worth of $5 million, all accumulated through steady saving and a paid-off house. Their trust says, on the first death, leave everything to the surviving spouse. Pretty standard. Robert passes away in January of 2026. Susan is devastated but financially secure. She files a simple estate tax return and elects portability, claiming Robert's unused exemption. Because the exemption was still high that year, she now has roughly $26 million of combined exemption. She thinks she is bulletproof. Then, Susan moves into assisted living and passes away quietly in 2028. The kids go to settle the estate, and because of the way the rules reverted, they find out that the actual exemption available at Susan's death was only $6 or $7 million. But they already closed the books on Robert's estate. The portability election might be locked in, but the calculation of the tax base, the step-up in basis for the house, and the liquidity needed to pay the tax could create a nightmare. If the trust had simply been updated to accommodate a disclaimer formula, or if the family had set up proper survivorship life insurance to cover the expected tax, the kids wouldn't be forced to sell the family home in a panic. This is not fantasy. This is a very predictable scenario that competent planning solves right now. Let's talk about the practical steps you can take this week. First, pull out the binder with your estate planning documents. Look at the signature page. If the date on that signature is older than 2020, consider the document a ticking time bomb regarding the tax sunset provision. Second, make a list of every financial account you own. Call the institutions or log on to the website and verify the exact spelling of the names listed as primary and contingent beneficiaries. Make sure there is a contingent beneficiary. If you name your spouse as primary and there is no contingent, and your spouse dies at the same time as you, your estate just became the beneficiary, which drags everything into probate. Third, schedule a consultation with a certified public accountant who understands estate taxation. Ask them to run a hypothetical calculation of your net worth under the 2026 reduced exemption scenario. If the numbers show a gap, you still have time to fund a spousal lifetime access trust or SLAT, or utilize the high exemption before it drops by making gifts before the 31st of December 2025. The truth is, this expiration date is not a secret. The IRS has been warning about it for years, but Wall Street and the media rarely cover it with the urgency it deserves because it is not a shiny, exciting story. It is a slow-moving train that arrives in about a year and a half. You have a window of opportunity right now to lock in planning under today's generous rules, even if you believe the exemption will never drop. Even if you think Congress will ride in on a white horse and save the day, betting your family's entire financial security on a political prediction is a losing game. The cost of updating a trust or a beneficiary form is measured in a few hours of a lawyer's time or a few clicks on a website. The cost of not doing it is measured in millions of dollars of lost intergenerational wealth. You have worked too hard, sacrificed too much, and saved too diligently to let an arbitrary date on the calendar undo your legacy. Take a deep breath, gather your documents, and make the call. Your future self and your children will thank you for taking action before the clock runs out. Now, if this video is helpful in explaining how the 2026 tax expiration might impact your family, please take a moment to like this video so the algorithm shows it to other folks who might need this warning as well. And if you want to stay updated on important financial changes that actually matter to your retirement, make sure you subscribe to the channel and click that notification bell. I would love to hear from you in the comments below. Are you planning to update your trust before 2026? And have you found any surprises in your old beneficiary forms? Share your experience down below, because your story might just be the wake-up call someone else needs to hear.